Welcome to our presentation on digital currencies, Unraveling the Future of Finance. In this engaging and informative session, we will explore the fascinating world of cryptocurrencies and the transformative impact they have on the financial landscape. By the end of this presentation, you'll have a comprehensive understanding of the fundamentals of blockchain technology, the benefits of crypto in financial services, the challenges and concerns that the industry faces, and a glimpse into the future of finance and blockchain. Specifically, you'll gain insights into the mechanics of blockchain, smart contracts, and decentralized applications, along with their implications on various sectors, such as real estate, supply chain management, and insurance. Additionally, you'll learn about the potential of central bank digital currencies, CBDCs, in addressing financial inclusion and the role of wallets in simplifying user interactions with digital currencies. Moreover, we will discuss the hurdles that the industry needs to overcome, including issues related to stablecoins, centralization, money laundering, and security risks. Finally, we will explore the exciting future prospects of blockchain technology such as cross-chain interoperability, real-time settlement in capital markets, asset tokenization, self-sovereign identity, and the convergence of generative AI and crypto in the metaverse. Join us on this journey as we unravel the complexities of digital currencies and reveal the immense potential they hold for reshaping the future of finance. This presentation will not only expand your knowledge of the subject, but also empower you to make informed decisions and actively participate in this emerging digital economy. By understanding the transformative power of digital currencies and the underlying technology, you'll be better equipped to navigate the rapidly evolving financial landscape and seize the opportunities that lie ahead. Whether you're an industry professional, an investor, an entrepreneur, or simply someone curious about the world of digital currencies, this presentation aims to provide you with valuable insights and a solid foundation to understand the ongoing revolution in finance. Just a brief introduction. My name is Litonjua, and I lead our Vacuumlabs cryptocurrency sales initiatives. We're a software engineering company focused on delivering and deploying fintech products and specialized primarily in digital banking that have recently entered the crypto space. I focus on helping corporates integrate blockchain technology into their products and also DeFi native apps write and audit their smart contracts. What is a blockchain? Blockchain is a decentralized ledger that records transactions across a network of computers. Each block in the chain contains a number of transactions, and every time a new transaction is added to the block, it is added to the chain, creating a record that cannot be altered. The easiest way to think about a blockchain is a Google Sheet that everyone has access to. In this Google Sheet, we can collectively decide the contents of the next cell, but the specific hash of the content is based on the previous cell's content. The key feature of blockchain technology that makes it useful for cryptocurrency is that it allows for secure, transparent, and tamper-proof record keeping of all transactions in the network. Each entry can be thought of as a transaction from one person to another person. The content of each cell is hashed. You can think of it as a digital fingerprint, and the next hash is calculated using the previous hash. This prevents the blockchain from being tampered with because if a previously written cell's content is altered, the hashes of the subsequent cells are different. If you look carefully, you can see that you can achieve pseudo-anonymity with crypto transactions, as instead of a person's name or address, you instead see an address. This is one of the attractive features about crypto. And to start trading and interacting with DeFi apps and protocols, you typically don't need to do any KYC, you just need to have a Web3 wallet. Cryptocurrency is a form of digital currency that uses cryptography for security and operates independent of a central bank. The key distinction here is that currency supplies are dictated by computer code rather than central bank. For example, Bitcoin has a hard cap on its supply, as there can only be 21 million coins in existence. The issued supply, currently at 6.25 BTC per block, halves every 4 years. No one can adjust or change this, and this is attractive. Bitcoin was the decentralized cryptocurrency and is still the most widely used. Others include Ethereum, Litecoin, and Ripple. Cryptocurrency transactions are recorded on the blockchain, which allows for the peer-to-peer transfer of digital assets without the need for a central intermediary like a bank. The attractive thing about cryptocurrencies is that each one of them can be designed to have a unique supply, emission, and burn schedule. So, moving on to smart contracts. A smart contract is a self-executing contract with the terms of the agreement between buyer and seller being directly written into the lines of code. The code and the agreements herein are stored and replicated on a blockchain network. Smart contracts allow for the automation of many contract processes, including the enforcement, negotiation, and performance of the contract. A good example of a smart contract is in an escrow exchange. In the olden days, if I wanted to purchase an item from someone but could not do it instantly, I would usually give my money to a trusted third party who would hold my money and wait until the counterparty gave the item. They would then exchange the money and the item and usually take a small fee. The trusted third party is usually the bank, but with smart contracts, this can be a piece of computer code instead. This vastly increases the efficiency and decreases the cost of an escrow. The table shows the different transactions that happens when people use a smart contract to sell the NFT. Each transaction has a special ID number and shows what happened, who did it, and when. The first transaction here shows someone named Alice put the NFT, but this can be anything really, into the smart contract. This means that the smart contract now holds the NFT and is waiting for someone to buy it. The second transaction shows that the smart contract was approved for sale of the NFT for 2.5 Ethereum. ETH is like a special type of digital money that people use on the Ethereum network. The third transaction shows someone named Bob using 2.5 ETH to buy the NFT from the smart contract. This means that Bob now owns the NFT. These smart contracts are the primitive building blocks of decentralized finance, and you can think of them as open source APIs but in steroids. Because most smart contract code is open source, it is easy to build upon them. For example, Alchemix, a self-repaying loan protocol, uses the Aave smart contracts, which allows you to earn a yield on cryptos to power their platform. They do not even need to ask Aave for permission for this or an API key. This allows much easier building and rapid iteration. Because they are stored on the blockchain, they are also transparent and secure. And this brings us to the next topic, which is composability. Composability allows for much more rapid iteration compared to traditional fintech products. For example, Alchemix, which is the self-repaying loan platform, was able to launch its platform relatively quickly, just 6 months after raising funds for a private sale in December 2020. The platform launched in February 2021 and has since seen significant growth, with over $2 billion in total value locked as of September 2021. This rapid time to market was made possible by leveraging the smart contract technology and liquidity of the Aave protocol, which allowed Alchemix to offer its self-repaying loans without the need for a central intermediary or credit check process. So by building on top of Aave's infrastructure, Alchemix was able to bring its unique lending product to market and offer a new type of financial service to its users. This type of smart contract composability enables companies to create new products and services quickly and efficiently, without the need for extensive development and infrastructure costs. The ability to rapidly iterate and innovate through smart contract composability is one of the key advantages of this DeFi ecosystem. And by leveraging the interoperability of different smart contracts and protocols, companies can create new financial products and services that were not possible before. This also highlights the potential for open source collaboration within the DeFi space, with companies building on each other's work to create a more interconnected and efficient financial system. No one wants to interact with a spreadsheet to get stuff done. Instead, we usually interact with a front-end interface. This is exactly what decentralized applications do. They put a pretty front end on top of the spreadsheet so regular users can interact with it. Aave disrupts the traditional peer-to-peer lending by offering a more efficient and secure way to lend and borrow cryptocurrency without the need for a middleman. With transactions processed almost instantly, Aave provides greater speed and efficiency than platforms like Lending Club, which can usually take several days to process loans and distribute funds because they rely on a central authority to manage loans and assess risk. By offering a decentralized platform, Aave provides greater access and opportunities for individuals and institutions to access the funds they need, without the fees and delays of traditional lending platforms. Uniswap, on the other hand, is disrupting centralized exchanges like Coinbase by providing a decentralized open-source platform for trading cryptocurrencies without the need for a middleman. The key difference here is it uses liquidity pools instead of an order book, which means you do not need to directly match counterparties for trading, but instead can even act as the middleman himself and earn fees by locking your money in these pools. These liquidity pools can also be permissionlessly created, which means users can create any type of token they want instead of having to go through an approval process for typical exchanges. Our final topic on this is wallets. Each decentralized application can be thought of as a spreadsheet with specific functionality And that wallet is your invite to edit the sheet by calling on specific macros that this dApp developer dictates. In this example, MetaMask is a Web3 wallet that allows you to securely store, manage, and interact with cryptocurrencies and other digital assets on the blockchain. You can think of it as your personal bank account for the decentralized world. One of the key things about a Web3 wallet is that you can use it to seamlessly interact with various applications, dApps, on the blockchain with just a single click. Instead of creating a new account for each dApp, you can simply connect your Web3 wallet to the dApp, allowing you to use its functionality without needing to create a new account. For example, if you want to lend cryptocurrency using Aave, you can connect your Web3 wallet to Aave and choose how much you want to lend for how long and what cryptocurrency you want to lend. Similarly, if you want to trade cryptocurrency using Uniswap, you can connect your Web3 wallet and start trading without the need to create an account. So by using a Web3 wallet, you retain full control over your private keys and your funds are stored securely in your wallet, rather than a centralized exchange or platform. This ensures that your funds are secure and you have complete control over them. Now let's see what are the impact on the financial markets. Self-custody, a core feature of crypto, has become increasingly important in today's world. This is due to incidents such as Canada's freezing of the bank accounts of hundreds of people who were associated with the trucking protests in early 2022, demonstrating that even bank accounts are not immune to government interference. By having self-custody of these assets, individuals can prevent such interference. Visa is acknowledging this paradigm shift and is preparing for a world where users may want self-custody of their funds. And to this end, they're even developing a more flexible user account that can natively use smart contracts through Ethereum's account abstraction feature. Smart contracts can be programmed on a per-account basis, allowing for greater flexibility and customization. It's really intriguing to observe how Visa is adapting to this future as self-custody becomes increasingly prevalent. Real estate processes and documentation is being improved via blockchain technology. For example, Figure uses blockchain technology in its lending process, which allows for a faster, more secure, and transparent transactions. The company has developed a proprietary blockchain called Provenance that facilitates loan origination, servicing, financing, and securitization. The Provenance platform enables Figure to execute and settle loans in a matter of minutes instead of days or weeks, as is the case with the traditional lenders like Rocket Mortgage. The blockchain technology used by Figure allows it to bypass intermediaries such as banks and lawyers, thereby reducing costs and providing borrowers with lower interest rates. Additionally, the Provenance platform creates a tamper-proof and auditable record of all loan transactions, ensuring transparency and accountability for all parties involved. Rocket Mortgage, on the other hand, does not use this kind of technology in its lending process. While the company has implemented some digital technologies to streamline the mortgage process, it still relies heavily on traditional banking methods and intermediaries, which can be slow, costly, and less secure. It's not just the paperwork improvements, but also in making real estate more accessible. Rooftop offers blockchain-based ownership and financing for real-world homes. Homes are first tokenized on the blockchain and can be purchased with one click, providing immediate ownership without traditional real estate closing hassles. It allows multiple users to buy a single property by creating an LLC for each property on the platform. This means that when a user buys a home on Rooftop, they're actually purchasing the ownership of the LLC that owns the property. As a result, multiple investors can buy ownership of a single LLC and therefore own a share of the property. This approach is particularly useful for real estate investors who want to spread their investments across multiple properties or team up with other investors to purchase larger properties. By pooling resources, multiple users can collectively purchase a property that may have been out of reach for a single investor without any minimum investment requirements. Parcel takes the idea a step further by using a custom valuation index based on aggregated data from public records, property listings, county records, and transaction history. This index represents the median price per square foot or meter for a specific area, such as New York or San Francisco. It uses an adapted version of the AMM technology used in Uniswap to allow you to go long or short these markets, so you're investing in the underlying price movement of real-world property values within the chosen real estate market. This is similar to participating in the derivatives exchange, and the goal of Parcel is to enable users to participate in the global real estate markets without the need for direct ownership, property management, or substantial capital outlay, and invest in cities on aggregate instead of individual houses, which reduces concentration risk. It's not just in real estate where blockchain can have an impact, but also in supply chains, specifically in luxury goods. Everledger, a technology company focused on traceability and provenance for high-value goods, has partnered with Rare Carat, America's top source of unbiased diamond advice, to bring enhanced transparency and sustainability information to the diamonds listed on Rare Carat's marketplace. Using Everledger's blockchain platform, customers can now search for and purchase diamonds with full traceability from mining and manufacturing to sale. This ensures that the purchased diamonds are conflict-free and sourced sustainably. The platform helps retailers searching for diamonds based on sustainability efforts, credentials, and compliance standards, and matches them with suppliers willing to securely share such data. The partnership aims to improve transparency in the diamond supply chain and boost consumer confidence in ethical sourcing. Luxury brands like Louis Vuitton, Cartier, and Prada have formed the Aura Blockchain Consortium to combat counterfeit goods through a blockchain-based seal of authenticity, providing customers with assurance that the products being purchased are genuine. Developed in partnership with Consensus, the Aura platform enables brands like Hublot to offer digital e-warranties stored in the blockchain, allowing customers to verify a product's authenticity using a simple photo taken with their mobile phone. This initiative comes at a time when the luxury market remains lucrative, with online sales reaching 58.9 billion in 2020, up from 58.9 billion in 2020, up from 39.7 billion in 2019. Insurance processes are being more streamlined by a blockchain. On the topic of supply chains, GuardTime and EY InsureWave, this is a blockchain technology company who partnered with EY, Microsoft, and a shipping company called Myers, developed InsureWave, a blockchain platform for marine insurers. InsureWave provides a shared ledger for insurers, brokers, and shippers, enabling real-time tracking of assets and risk exposures. The platform has been adopted by several insurance companies, including Maersk, Willis Tower Watson, and XL Caitlin. AXA and Fizzy. AXA, a leading global insurance company, launched Fizzy, which is a parametric blockchain insurance product for flight delays. Fizzy uses smart contracts on the Ethereum blockchain to automatically process and pay out claims if a flight is delayed by more than 2 hours. The smart contract connects to global air traffic databases and automatically triggers a payout when a delay is detected, providing customers with a seamless and transparent claims experience. State Farm and USA, two major insurance companies, partnered to explore the potential of blockchain for subrogation. This is a process through which insurers settle claims on behalf of their policyholders, in a car crash, for example. The companies use a blockchain-based solution to streamline and automate the subrogation process, enabling faster and more accurate settlements. With crypto payments, blockchain networks and their underlying cryptocurrencies have cross-border functionality already built into them. This makes them potential disruptors of traditional payment methods like SWIFT. San Francisco-based company Ripple has built a blockchain-based payment network called RippleNet that is specifically designed for direct transfer of assets. Ripple solutions such as Xcurrent and XRP target the high costs, time delays, and lack of transparency that are associated with SWIFT. Xcurrent provides real-time settlements, tracking, and transparency of cross-border settlements, while XRP acts as a bridge currency to facilitate direct asset transfers between parties, reducing the need for correspondent banks, and freeing up capital. Although SWIFT has launched a global payment innovation initiative to improve their system, Ripple is quickly catching up, with more than 100 financial institutions joining RippleNet, including Santander. Ripple solutions offer lower costs, faster transaction times, and greater transparency, making it a viable long-term solution for cross-border payments. BVNK is building their entire model on using crypto rails for cross-border payments. They currently process $2 billion in annualized payments and have raised $40 billion in Series A funding to accelerate its push for regulatory licenses and expand into new markets such as Spain back in early 2022. Their efforts came into fruition as they've secured registration from the Bank of Spain as a virtual asset service provider and able to expand across the European Union and beyond. Even governments are rethinking money by issuing their own CBDCs. This is primarily happening in developing countries where financial accessibility is a larger issue. The Cambodian CBDC project Bakong was launched in October 2020 to facilitate basic financial transactions on smartphones. While you might wonder, how is this any different from any e-payment wallet? People don't need a bank account to use Project Bakong's app. Simply having a Cambodian mobile phone number is enough to use the service. Project Vacuum has successfully provided financial services to more than 200,000 previously unbanked Cambodians. It's also helped over 1 million overseas Cambodians send remittance back home to their unbanked families. In the Bahamas, something similar is happening too, and they were actually the first country to launch their own CBDC. The sand dollar is meant to reduce money laundering and financial fraud, as well as increase access to financial services. Besides, it also helps create a clear record of financial transactions, making it easier to access the data necessary for microloan applications. CBDCs are already receiving a lot of attention, with 60 plus central banks studying digital currencies and 14% already entering a development phase for CBDCs. China itself started research in CBDCs as early as 2014, even before the advent of smart contracts. The Chinese government aims to improve the efficiency of its monetary system, enhance its ability to monitor and control financial transactions, and reduce its reliance on the US dollar in international trade. The digital yuan also has the potential to promote financial inclusion among China's rural and unbanked populations. However, not everything is rosy. Stablecoins are the private market CBDC and are ironically not as stable as one would think. Terra's USD coin collapsed in 2022, wiping out a $60 billion ecosystem in the span of a month. Terra's main USP was that it was a DeFi ecosystem enabled by a stablecoin that was pegged to the US dollar. Terra's USD stablecoin and Luna governance token experienced a dual implosion that led to the collapse of their value. The implosion can be attributed to several factors, including the mechanism behind Terra and its stablecoin, as well as general panic among investors. One of the main reasons for USD's fall was the reduced interest rates offered by Terra's Anchor protocol, which led to the mass exit of USD holders. To exit USD, holders had two options: Terra's burn and mint mechanism, or turning to stablecoin exchange Curve Finance. The burn and mint mechanism allowed holders to swap one USD for $1 worth of Luna, destroying the USD in the process. This mechanism created an arbitrage opportunity when one USD fell below $1, as speculators could buy the discounted USD and trade it in for $1 in Luna, making a small profit. However, as the price of Luna dropped, swapping one USD for $1 worth of Luna required more and more Luna, leading to more Luna being minted, diluting the supply and further dropping the price of the token. At a certain point, the price of Luna could drop so low that there wouldn't be enough liquidity to provide an escape for all incoming USD. As for the second option, Curve Finance, the pool that allowed for trading USD and other stablecoins became unbalanced, with more USD than other stablecoins in the pool. This led to USD being offered at a discount, but the rebalancing trade wasn't happening, further contributing to USD losing its peg. As a result, USD lost its peg, and Luna price plummeted, creating a negative feedback loop that led to an enormous amount of bad debt. The Terra community attempted to address the situation by increasing the amount of Luna that could be minted at the time, but this only accelerated the downward spiral. Ultimately, the implosion of Terra's USD and Luna serves as another example of an algorithmic stablecoin's collapse, and the founder Do Kwon has since been apprehended as of March 23 this year. Now, previously we discussed the collapse of Terra Luna, which had a significant impact on 3 Arrows Capital, one of the largest crypto investment funds. At its peak, 3AC held over $10 billion in assets, but the fund collapsed due to over-leveraging. A major part of their investment portfolio was Luna tokens, amounting to over $200 million, which became virtually worthless after the implosion of the Terra ecosystem in mid-May. The investment strategy of 3 Arrows involved borrowing capital from various sources within the industry and subsequently investing in emerging crypto projects. The founders, Suzu and Kyle Davies, who had been in the industry for a decade, gained credibility in a field often dominated by newcomers. Zhu also co-hosted his popular podcast on crypto, and the firm engaged in margin trading of major token pairs, but failed to meet the margin requirements when ETH and Bitcoin experienced a sharp decline, causing a ripple effect across all markets. Interestingly, the narrative surrounding cryptocurrencies often emphasizes decentralization. However, this situation highlights the centralization risk present in the industry. Crypto's decentralized and anonymous nature has made money laundering considerably easier. One method hackers can employ to avoid detection is through coin mixers like Tornado Cash. which highlights some of the negative aspects of cryptocurrency and its potential misuse. Tornado Cash operates by allowing users to deposit funds into smart contracts, which then provides a unique private key. This key can be used to withdraw crypto into any other wallet address. Recently, the US government sanctioned Tornado Cash, and its developer, Alexei Pertsev, was imprisoned for creating the open source code. Since 2019, Tornado Cash has allegedly laundered over $7 billion worth of currency. Another example of money laundering with crypto is the use of privacy coins like Monero. Monero transactions are designed to be untraceable, employing stealth addresses and ring signatures to obfuscate the sender, receiver, and transaction amount. This anonymity makes Monero an attractive choice for those seeking to launder money or conduct illegal activities. As a result, governments and regulatory agencies are increasingly scrutinizing privacy coins and implementing measures to curb their use in illicit transactions. In Dubai, for instance, new laws published in February 2023 prohibit the issuance and all activities related to anonymity-enhancing cryptocurrencies, such as Monero. These long-awaited regulations set licensing and authorization requirements for virtual asset companies and issuers looking to operate within Dubai. There are also security risks, which are high. Attackers often target individual wallets and bridges, such as evidenced by the recent incidents involving Solana's Wormhole and Seth Green's Bored Ape NFT. Wormhole is a cross-chain crypto bridge, which experienced a hack where 320 million in wrapped Ethereum was siphoned out of the protocol. The hacker exploited a vulnerability in Wormhole's Guardian accounts, minting 120,000 week without any backing. The Wormhole team has since fixed the vulnerability and restored all funds, ensuring a one-to-one backing with the WEEF. In another case, actor Seth Green's Bored Ape Yacht Club NFT was stolen after his crypto wallet was compromised, putting his new animated series White Horse Tavern on hold. Green no longer holds or owns the rights to the Bored Ape NFT, meaning he doesn't have the permission to use the character in the animated series. The current owner of the stolen NFT also has no plans to return it to Green, and these incidents highlight the need for improved security measures and solutions to address vulnerabilities in the rapidly evolving world of crypto and NFTs. One of the most interesting things about crypto is the ability to experiment with different economic models, as well as we will see in the story of Axie Infinity. However, so far, no company or organization has really cracked the secret sauce for a sustainable on-chain economy. During the 2021 bull run, metaverse and gaming economies played a significant role in the narrative, with Axie Infinity leading the charge. At its peak, Axie generated over $17.5 million USD daily in marketplace fee revenue from NFT sales and DEX swaps. And as someone who's participated in the game, I witnessed firsthand the potential of crypto to transform the lives of those in developing countries, while also recognizing that the ideal economic model and token model remains undiscovered. Axie Infinity's mechanism were slightly more complex than typical auto compounders, which is the yield farms. Players use NFTs such as Axies, which generated utility token SLP through battles. SLP payouts depend on the player's rank, with higher rank players earning more SLP. Players could use SLP to breed these additional Axies, increasing the earnings if the right players were found. And they use what's called the scholarship model, where you essentially paired asset owners with players, forming the basis of gaming guilds like YGG. However, demand could not keep up with supply, leading to SLP overinflation and reducing average player earnings. And to achieve sustainability, demand must match the exponential growth of Axies in the marketplace. Interestingly, Sky Mavis, Axie Infinity's parent company, implemented their own wallet and decentralized exchange, demonstrating the close relationship between gaming and finance. The notion supports the metaverse thesis, where individuals will live entirely virtual lives within a completely virtual environment and economy, with games being the initial manifestation of this concept. Now let's talk about the future of finance and blockchain. Number one is with cross-chain interoperability. Cross-chain interoperability tech could consolidate markets and liquidity across multiple chains, creating a more unified and efficient blockchain ecosystem. The issue right now is that there are many different blockchains with different technical architectures, and capital is splintered across all these ecosystems. Because of the lack of standardization of tech, it's difficult for these chains to communicate and talk with each other. However, tech such as Layer 0 addresses exactly this problem. It's a trustless omni-chain interoperability platform that enables cross-chain transactions without intermediate steps. and it utilizes two independent off-chain entities, the Oracle and the Relayer, to achieve valid delivery without requiring costly cross-chain state, machine replication, or intermediary tokens. And there are various innovations that can come out of this. The first one is a cross-chain DEX, which deals exclusively in native assets and allows users to deposit native assets in one pool and withdraw them from another without the need for wrapped coins or intermediary sidechains. The number two application is in a multi-chain yield aggregator, where yield aggregators can tap into opportunities across multiple ecosystems, increasing access to these high-yield opportunities, enabling users to take advantage of the market inefficiencies. And number three is in multi-chain lending. For example, it's a lending protocol that allows users to keep their assets in place on one chain, lend them out, and borrow them directly in another chain's native currency, eliminating intermediary costs such as bridge and swap fees. These examples represent the possibilities that platforms like Layer 0 enables, and developers can build applications without worrying about differing semantics between inter and intra-chain applications and intra-chain transactions, and users can move liquidity freely across chains. If this kind of topic interests you, we here at Vacuumlabs actually have experience with this technology and are more than happy to chat with you about whether your project would benefit and do a direct Layer 0 implementation too. Another use case is in real-time settlement of capital markets, and this could be a new paradigm that revolutionizes the financial industry. The Depository Trust and Clearing Corporation, DTCC, it's a premier post-trade market infrastructure provider, and they've embarked on an ambitious project called Project ION, which seeks to modernize the capital market infrastructure using distributed ledger technology. And they aim to shorten settlement from 3 days to 1 day by 2023. Their current system can handle 100,000 to 160,000 equity transactions per day. And traditionally, capital markets settlements take days to complete, which exposes the involved parties to counterparty risks and increases the chances of errors in the process. Real-time settlement, on the other hand, enables instantaneous transfer of assets between parties, reducing these risks and improving the overall efficiency of the system. Unfortunately, capital markets have been operating with legacy systems for decades, and these systems are deeply entrenched, making it difficult and time-consuming to replace or upgrade them with a new technology and enabling real-time settlement. However, the fact that the DTCC processes over 2.15 quadrillion in securities transactions annually is the fact that they're executing this project shows that they believe that there is promise in using this technology even in capital markets. Another interesting aspect is in asset tokenization, and this could become more mainstream and diverge from the usual asset classes such as real estate and enter broader asset classes. Some examples could be art and collectibles. Tokenization can be applied to the art collectibles market, allowing for fractional ownership of high-value artwork and other items. For example, platforms like Masterwork enable investors to buy shares in tokenized artworks, making the art market more accessible and liquid. Right now, they aren't Web3 enabled, but expect to see a rise of such platforms in the future. Another one is in intellectual property. Tokenization can be used to represent intellectual property rights, such as royalties from books, music, or patents. This allows creators to sell fractional ownership of their creations, providing them with immediate capital while allowing investors to benefit from future income streams. For example, the platform Royalty Exchange facilitates the buying and selling of tokenized intellectual property rights. And finally, private equity. Historically, private equity needs to be held for 10 to 12 years before getting sold off. However, tokenization could increase liquidity in this market by enabling trading of tokens even at the onset of purchase. This is potentially a big market because there's roughly 8 trillion of private assets globally, and liquidity is the biggest issue for investors in this asset class. There are already some competitors, companies such as Currencies and Peregrine Digital who are already looking into the space. Self-sovereign identity is something that's really interesting, and this could be made possible using ZK zero-knowledge enabled tech. This technology allows individuals to prove they possess certain information without directly revealing the specifics. One of the best examples I can think of is a Where's Wally proof using zero-knowledge. Say someone wants me to prove I know where Wally is in the picture without disclosing information of the exact location. I would provide a large cardboard cutout 4 or 5 times the size of the original image with a cutout of Wally. I would place the paper beneath the large cardboard cutout and prove that I know where Wally is without disclosing the exact location by overlaying it. So the observer does not know the orientation of the page, but I can prove to him I know where Wally is. ING also created this ZK solution, which adds a range factor that allows users to prove that they have a secret number that lies in some sort of known range. For example, a mortgage applicant could prove that their salary sits within a certain range without revealing the exact figure. This is particularly useful in today's era, where privacy is paramount. So imagine a future where we no longer have to provide all of our personal details, but instead can selectively disclose what information we choose to reveal. We may not even need to share our name or identity to use a service. This could create a whole new class of applications and allow users to really own and control their own data. We could have transaction histories across multiple addresses and prove that we have ownership of them. We could also use some sort of off-chain identity to link these wallets. And to get a mortgage approval in future, all we may need to do is connect to the wallet, and it can query our transactions on the record and automatically approve or reject us. We touched briefly on the metaverse, but perhaps the most exciting future of all is in the combination of generative AI and crypto. Together, these can create the next version of the metaverse where we could have autonomous versions of ourselves interacting as agents in the metaverse 2.0. The picture above was generated by putting the original image and then running the prompt in Midjourney V5. In 5 minutes, this Pixar 3D model was generated. Combine this with GPT-4, trained on your text messages and email, and it's not so hard to imagine a future where you can have autonomous replicas of ourselves interacting in this new metaverse. With the announcement of GPT plugins, these, AI-enabled bots could take over the mundane tasks and use crypto to pay APIs or other services so that they can access certain information and act accordingly. Crypto could be the internet-native payment mechanism by which these autonomous agents can interact and provide value to one another. So where are we? We're just at the tip of the iceberg, the start of the story. And as we delve into the world of cryptocurrencies and the technologies that underpin them, it becomes evident that we're witnessing a paradigm shift in the financial landscape. The fundamentals of cryptocurrencies lie in the blockchain, a transparent yet immutable digital ledger that enables the transfer of value between participants. They're powered by smart contracts, which automate actions, and composability allows seamless integration with external systems. Decentralized applications provide the user interface for these ecosystems, and wallets enable users to interact securely without needing specialized knowledge. The impact on financial services is extensive, with benefits ranging from self-custody to streamlined processes in real estate, supply chain management, and insurance. Crypto cross-border payments are more affordable than traditional networks like SWIFT, and the governments worldwide are addressing financial inclusion with central bank digital currencies. However, challenges and concerns remain. Stablecoins are not always so stable. Centralization of assets could lead to contagion, and the decentralized and anonymized nature of crypto could make money laundering easier. Security risks are high, with attackers targeting individual wallets and bridges, and tokenomics is still an evolving field with no one really cracking the code yet. Yet the future of finance and blockchain holds great promise. Cross-chain interoperability technology could consolidate markets and liquidity across multiple chains, enabling real-time settlement and capital markets. Asset tokenization may become mainstream, and self-sovereign identity could be achievable using zero-knowledge-enabled technology. Generative AI in crypto could drive the next iteration of the metaverse. Who knows what lies beneath the surface, but one thing's for sure, I'm really excited to find out. Thank you so much for attending my presentation. And I would like to invite my friend and colleague, Tomas Stranovsky, if he's available for a brief Q&A. The first question is how do you see blockchain technology impacting your company and the industry in the next 5 years?
Well, I really see a big potential in bringing more of our users in Realis from Web 2 to Web 3. As at the moment, it is really hard to develop whole game on the blockchain.
Mm-hmm.
I never saw anything like this yet. Yeah, and also yeah, as even brands like Rockstar Game are considering implementation of the blockchain. maybe you heard about it. I'm not sure if you did.
I'm not sure if I have heard about that, but it's interesting to hear that like a lot of the mainstream developers are like getting into it now.
Yes, yes, exactly. And like likely, many AAA games companies are like considering to use blockchain in the future. But there is still no explanation for them like how to do it.
And
Yeah.
what are the potential risks and benefits that you consider before investing in like blockchain and cryptocurrencies?
There were many factors to consider. First of all, I need to teach myself basics about the blockchain and Bitcoin itself, how it works, how to create a wallet, how to send my first transaction. So I started with Bitcoin faucets, and this is how I actually earned my first satoshis, or let's say first, Bitcoin, some Bitcoin amount, because in 2017 you could earn a nice amount of satoshis doing this faucet. Maybe you did this in the past or not. I'm not sure.
Yeah, so like for me actually like I got burned like in back in I think it was 2017, 2018. Like I think I invested at the height of like the cryptocurrency bubble, and then like I lost like 80%.
And
Then
yes, and that's my next point. Do you remember the ICO boom in 2017? I guess you
yes,
do.
exactly.
Yeah, and it was XY projects fundraising money, and you had to do proper research to find a real project, as many of the projects were just simple money grabs.
Yeah.
I was mainly looking for team members, their experience and background, reading the white paper, and then the roadmap, asking questions, and then overall I summarized everything if the project is worth any investment. So like this is advice for anyone who is trying to invest or like doing some decisions. So in general, before investing in any crypto project, always do proper research and don't listen to anyone. You always should have your own point of view for each project you're researching.
So
Always,
like
yeah, you should always have your own opinion, because someone can say this is cool, but you will see, let's say, some red flag, and it will tell you do not invest. Yeah.
so like I'm curious. Like, what is your due diligence process when you're looking at like specific projects, or like are you even investing in this current market condition?
Currently, maybe I have something in my mind, but not I'm not hustling any like investments like right now. It's like I'm not looking for new projects.
Yeah, like I think like right now like the market's kind of like still in its phase of like bottoming out. It's not like in back in 2021 where like everything like was flowing and everything was like getting funded. But
Yeah, yes. But if I find something interesting, I will definitely jump in. But as I said, like for anyone who is here, it's always good to have your own opinion, and do not listen to just one guy. Just always ask questions, and then make sure to summarize everything, and then you will decide if you invest or not.
and like what in what ways like has blockchain improved the security and transparency of like your company?
Uh, in 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 our company, Realis Network, blockchain has improved our products a lot. Our token is based on the Near protocol. There are actually very cheap fees comparing to Ethereum, and also Near protocol is it's like you are using only Rust. Rust, and it's easy to create a smart contract. For security reasons, we hold most of the tokens in cold storage. So even if our website or our services are compromised, the attacker will only be able to get small amount of LIS tokens that are stored in a hot wallet.
Right.
Yeah, because we store for our players. We are still in Web 2 and slowly merging to Web 3. We own only small amounts of the hot wallets. And if someone will request higher withdrawal, we will of course move some funds from cold storage to our hot storage, so we can send the transaction. And also on the other hand, blockchain also help us with transparency, because anyone is able to see how many transactions were made, how many tokens are locked, and as we have a maximum supply set. So there is no way that there will be more allies tokens than the maximum supply.
Mm. And my final question, as blockchain gains mainstream adoption, like what impact do you think it'll have on the financial system of like your country?
This is good question, but this is good question actually. But now the question is for you, Eddie. What country do you mean? Do you mean Paraguay or Slovakia?
Like
I'm
let's like do it for like Paraguay, for example.
Paraguay. Okay. Well, to be honest, I see a huge potential in South America, because it is kind of difficult to withdraw bigger amounts of cash to the ATMs. Because, and also the banking system in South America is very outdated, very slow, and it's hard to get like account for the US dollars.
Yeah.
Each country has its own currency. Each of these South America countries. And mass cryptocurrency will definitely help a lot of foreign investors to buy properties or buy other services as well. In South America, we have several countries, and each country has a different currency here. I think it will make life in South America much more easier if more people will be accepting cryptocurrencies as a payment. I have even live example, because I'm moving there in 2 months, and I actually I reserved an apartment. But the problem is,
Like an apartment using cryptocurrencies.
no. Actually, I want to explain why it will be good to have like a huge crypto adoption in the South America, because let's say now I reserved an apartment in Asunción, and now the problem was they are not accepting cryptocurrencies, because if they do, they will send me address, send me USDT, send me BUSD, send me Bitcoin, send me Ethereum, whatever, and just send. But now I had a problem to transferring money to the reality agent from my country to Paraguay. I had to use Western Union. There are some fees, and also there was some problem because the name on the ID and the name I provided to the Western Union didn't match, and they don't want to give her any money. So I have to solve it today. So this is my actual experience.
Yeah.
And if they will accept the cryptocurrency payment, I will just simply send any cryptocurrency they will want, and it will be solved in minutes. And
Yes.
now it's 10. This is taking days.
Yes.
Because the payment, because the reality agent is not able to claim the money from the Western Union, and now I had to fix it. And now hopefully today she will manage to get the cash from Western Union.
Yeah, and like, sorry, go ahead.
Yeah. So definitely in South America I see a huge potential, because they're also crypto friendly, and I saw in Asunción like few Bitcoin ATMs, and they're slowly trying to grow.
Yeah, I think that's really great, and like thank you for sharing your insights. I think
Yes, and also I will continue now about Slovakia and Europe. I don't know what to expect, as Europe is very conservative and is against the cryptocurrencies in general. Like ban of anonymous cryptocurrencies like Monero, for example, as you mentioned in the presentation. Europe also banned Monero because it's a privacy coin. And my opinion about Slovakia, or let's say in Europe in general, I think likely Europe will try to regulate crypto um, more and more, and this and actually trying to distract people from using it, comparing it to the South America, which is actually seeking for crypto adoption.
Yeah.
And especially, I do not trust our government as they are doing everything against the people. So I literally decided to move out from the Europe.
Yeah, that's like really interesting. I'm also like kind of like looking at some of like audience questions because I'm kind of like want to like also transition to there. But
Yeah,
Thomas, you
sure.
can like also like add your insights. There's one really interesting question from Martin of like, where do you see opportunities for permission chains or institutional use cases for permissionless chains in CEE? Um, for like CE specifically, I am not so actually so familiar about like the like demographic problems there, but I think that there's a big need for capital markets to for example like real-time settlement like within capital markets and asset tokenization. So I think those are like the two biggest, but they're not really CE specific. Do you have any like insights, Thomas, about like what the needs are like within CEE for these like permission chains that you've seen or
This is actually not my topic at all.
yeah.
So I really can provide a good answer for this.
That's okay, but kind of like moving on to like Martin's other question. What is our direct experience? What Vacuum Labs dev team with like Web3 projects, concrete examples if possible. So we actually started our journey in crypto back in 2018 in the Cardano space. And we developed like their first wallet called Adelaide. And now we're moving to a cross-chain wallet called NuFi, which does Ethereum, Solana, as well as like Cardano. And our recent projects include API 3 and Milkomeda. API 3 is basically providing like an API for like Web3 services, and Milkomeda is basically like a cross-chain application that allows you to basically use the apps on Ethereum or Algorand on Cardano. So essentially, like you can write an app in one language but port it into like another language. That's basically like what we've been doing, and we've also been doing some crypto app prototyping with like a bunch of like banks in Slovakia as well. So those are like kind of our concrete experiences. So we have like a lot of deep.
Yes, and you also doing actually ledger integrations
Yes,
that you are helping.
exactly. So like we're actually helping Thomas as well with ledger integration for like Nevio. So we also have like understanding of like how to do like the hardware and security stuff around that, right? Second question, are there any parts of DeFi or other infra VL is white labeling or selling multiple times? Typically, like we actually do bespoke kind of projects. Although like we built like a decentralized exchange. With like Wing Riders, we partner with Wing Riders to do work with them. Also, we built Jam on Bread, which is the NFT marketplace. So we have familiarity across building like the typical D apps, right? Especially within like the Cardano ecosystem. But right now, like we don't really have something that is white labelable. Like usually, like we use certain providers like Layer Zero to help, for example, do migrations of like assets or like NFT and liquidity like across multiple chains. But nothing is really like white label because typically our clients want something that is very custom built, right? So and then on your third question, what is your view in AI and Web3 together? A project, a thesis, a value chain ad, not separate AI versus separate Web3. So like my like specific view on this is that it's still something that's very early. Like the two fields haven't really kind of like coalesced together. I think they're both developing in like interesting ways. But where I think like what like Web3 and like crypto could be really interesting is if you I'm not sure if you recently saw like the paper where they essentially used GPT-4 and created like a matrix like universe of 25 autonomous agents interacting, right? So it's really cool because you have these agents who go out on dates with each other, they talk to each other. So it's like the world of the Matrix, but with these like 25 GPT enabled agents. So you can imagine a sort of world where in the future these agents might be transacting in that in like cryptocurrency in order to like access services to like buy things from each other. So it's developing. I think it's not yet here right now, like that intersection of like AI and Web3, But I feel like Web3 and cryptocurrencies will be that native payment currencies for these AI-enabled bots. So if you can almost like imagine a future where you have like these autonomous AI agents all talking to each other and helping us with our tasks, they'll communicate with each other. And for like an exchange of value, they might use cryptocurrency instead of traditional payments, because that is like what is internet native, right? So from what I've seen, there hasn't really been any intersection yet between these two, although like I think that will come out in greater use cases, especially like, for example, if you have like the metaverse thesis that Mark Zuckerberg is going for, um where you've got like these gaming worlds. You could imagine having like these autonomous NPCs that are enabled by like ChatGPT, and these could interact with each other in their own virtual economy. Then you could use cryptocurrencies to basically be the underlying payment layer. um yeah. And on your point four, what is your take on RWA real world assets from regulatory standpoint point of view in the CEE region? um I'm not so sure like about the regulations regarding within like the CEE region, but however, like here in the Philippines, there is some like there are some explorations about like tokenizing like real estate. Um, Also like in the US, that's where like the market is the most developed in terms of like asset tokenization. Like we see like a lot of like the private equity stuff being tokenized there. Um, but I think it's really dependent on the government and their view on like on this, because obviously it like takes power out of them if they're, you know, if they're allowing these things to happen, right? So I don't think I can like comment really on the CE region, but I feel like more and more like real world assets will start to become tokenized over time as this technology gets more broadly adopted. And that kind of like relates as well to my question of, should it, the anonymous participant, shouldn't we be a bit pessimistic about blockchain after the market crash of 2022? Yes, yes. Like I think that's like we should, like in terms of like prices and hype. But for me, like coming from the Philippines, and like I saw like the impact that Axie Infinity could have on like some of like the poorer populations, right? I saw that like, you know, someone was able to like buy medicine for their grandfather by playing this game. And it's like, this is something that I've never ever seen before. And it was just like a flash in the pan, maybe like 6 to 9 months where this was happening, because the economy obviously couldn't be sustained. But that gave me an insight into the actual power of the underlying technology. And there is actually something within the technology here that is really interesting to pursue, right? And one of that could be like on my side, self-sovereign identity, where you might not even have to disclose all your personal information anymore, because if you have everything via like this Web3 kind of interface, you can selectively disclose what information you want to share, right? And you wouldn't have like that would reduce like the, you know, the risk of having a data breach of a company, because the company does not become like a central hub of all that data anymore, right? So that technology is actually there. It just hasn't found that like product market fit yet. And I think the narrative has so often been dominated by these players, like for example, like Do Kwon, you know, who wants to, you know, they're like they want to like, you know, pump their coin and all that stuff. And unfortunately, that is the prevailing narrative of crypto. But
Yeah.
actually, when you look at the underlying technology, there is something that is interesting within that, right? And I've kind of seen it because I'm from the Philippines. Like I've seen like how it's been impacted, and you know, like even the way how easy it is to pay like someone else in another country using crypto rails, it's so much easier than like, you know, doing like a wire transfer, right? So I think yes, like we should be like pessimistic about like like the projects, but I think there's really something with the underlying technology underlying that, right? And yeah, if you have like any follow-on questions, Martin, like please feel free. You know, like I you asked quite a lot.
That's pretty much it. I mean, I agree with you. The last point is just the integrity of the industry is under attack the last 2 years. So I agree with you that technology is real, and it depends like where we're gonna take it from here next 10 years. So
Definitely.
your answers were pretty spot on spot. So that's all.
Thank you very much.
As well.
Yeah. And I'm just going through like some of the last couple of questions. BJ is asking how to get a copy of the recording. I think we'll actually be putting this on our website. So that should be fine. Are digital coins, e.g. CBDCs, without networks at all possible, e.g. coins in wallet and phone, but exchange using Bluetooth? Um, I have not actually thought of that. Like, it might be difficult, it might be possible, but I haven't really seen one that is done at scale. I think there was like there 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 was a project before called Helium that tried to use hotspots, and they used cryptocurrency to incentivize the purchase of these hotspots to create some sort of like Bluetooth network, right? But using Bluetooth for like native payments without some sort of network, I'm not sure if that's possible. Three inputs on El Salvador's experience as a unit of exchange. So Salvador like actually implemented Bitcoin like as a as a reserve currency. And I think this is interesting because I think it's in countries where you have like a hyperinflating currency that they see like Bitcoin as a store of value. And this kind of narrative is even backed up by like guys like Balaji Srinivasan, who used to be CTO of Coinbase. And he believes, I think, Bitcoin will be 1 million in like, I don't know, one or 2 months, right? So I think regarding like countries adopting cryptocurrencies as a unit of exchange and like as a trusted, you know, currency, I think this is mainly because, you know, like printing out money. And whereas with cryptocurrencies, you really have something that is where your supply mechanism is basically fixed and governed by code. So there's full transparency on the blockchain as to like what so you know what the exact inflation rate of the country is. So your purchasing power is like, it is being diluted, but like it's diluted at a predictable rate. Whereas when you have like stuff like quantitative easing where they print out like lots and lots of money, your purchasing power actually goes down. So if you don't have a salary increase, you're actually becoming poorer, right? So I think those are kind of my thoughts on El Salvador. Acceptability as a unit of exchange. Um, I think Bitcoin, regarding like Bitcoin and Ethereum, like Ethereum's actually like the base native payment currency for the Ethereum network. So I think for smart contract interactions, there will always be some sort of demand. But I think having a stable price is really important for people. So I think it will either be CBDCs or stable coins, which will eventually like win out the arms race. You've got, for example, like USDC and USDT, who are like the two major stablecoin players. But you've also got like countries like China who are experimenting with their own CBDCs as well, right? So I think we'll possibly be living in a world where you're going to have like multiple CBDCs and stablecoins accepted like as a form of payment. And especially like if you like think about the thesis where you're going to have, you know, cross-chain like liquidity, and you know, like when everything starts to like aggregate and you have like these cross-chain interoperability protocols, you're going to have like much deeper like liquidity as everything kind of like aggregates, right? So I feel like that's the potential future where we'll move towards, where each country will have their own kind of stablecoin or like their own CBDC. But who knows what the future holds. So I hope you found this session informative, and yeah, thank you so much for attending, and thank you, Thomas, as well, for like sharing your insights.
Thank you so much, Eddie, for the invitation, and hopefully in the future we can speak again.
Definitely, yeah. Thank you so much, guys.